Looking for high income and diversification? Dive into business development companies or BDCs. These unique vehicles offer access to private markets. Let's quickly see how they work, why they're compelling, and what to know about some top players. BDCs are publicly traded companies that act as specialized lenders to small and mid-sized private businesses. They fill a crucial gap, providing financing where traditional banks might not. Their income primarily comes from interest on these direct loans. The major draw: BDCs must distribute at least 90% of their taxable income as dividends to avoid corporate tax. This means most earnings flow directly to you, the investor, leading to those famously high distribution yields. Why consider BDCs? High, often double-digit yields. Access to private credit markets for diversification. And you get professional management of complex private loan portfolios. But important considerations include dividend stability, underlying loan quality, interest rate sensitivity, leverage, and fees. Now let's explore some key BDCs. Remember, yields are approximate as of mid-July 2025 and change daily. Always verify current figures and do your own research. TriplePoint Venture Growth. Yield, around 19.4%. Operations, provides senior secured loans, often with equity warrants, to high-growth, venture capital-backed tech and life sciences companies. Outlook, risks, and opportunities, highly exposed to venture capital market health, leading to potential dividend volatility. Opportunity for significant upside if portfolio companies succeed, but faces higher credit risk if startups struggle. Hercules Capital. Yield, around 9.9%. Operations, a leader in venture debt, offering structured debt financing to innovative tech and life sciences firms with disciplined underwriting. Outlook, risks, and opportunities. Stable outlook due to strong market position and rigorous selection. Risks tied to tech sector volatility. Opportunities from consistent deal flow and benefits from higher interest rates. Blue Owl Capital Corp. Yield, around 11.3%. Operations, one of the largest, focusing on direct senior secured and unitranche loans to established upper middle market companies, often with private equity backing. Outlook, risks, and opportunities. Generally stable, lower risk due to borrower maturity and scale. Vulnerable to broad economic downturns, but benefits from strong private equity relationships and private credit growth. Blackstone Secured Lending. Yield, around 9.9%. Operations, leverages. Blackstone's vast platform to originate first lien, senior secured debt for private U.S. companies, prioritizing credit protection. Outlook, risks, and opportunities. Solid outlook from institutional backing and conservative focus. Risks from middle market credit cycles. Opportunities from exclusive deal flow and strong downside protection. Prospect Capital. Yield, around 17.6%. Operations, large, highly diversified across various debt and equity investments in middle market companies, including some real estate and CLOs. Outlook, risks, and opportunities. Mixed outlook due to portfolio complexity and past non-accrual challenges. Potential for higher returns from diverse, opportunistic investments, but requires careful monitoring of asset quality and dividend coverage. Oxford Square Capital. Yield, around 16.9%. Operations, uniquely focuses on investing in high-yield CLO equity and junior debt tranches. Outlook, risks, and opportunities. Very high yield, but significantly exposed to leveraged CLO structures and broader corporate loan market performance. Offers extreme income potential, but with higher risk and NAV volatility. Great Elm Capital Corp. Yield, around 13.6%. Operations, invests in income-generating debt and equity, with a notable emphasis on specialty finance companies and unique, less liquid credit opportunities. Outlook, risks, and opportunities. Dependent on successful execution in niche markets, leading to potential for outsized returns from undervalued opportunities, but also higher risk from concentrated or illiquid positions. Monroe Capital Corporation. Yield, around 15.6%. Operations, provides senior secured and unitranche loans to middle market companies, known for a conservative, first lien focused portfolio. Outlook, risks, and opportunities. Generally stable, benefiting from its secured lending focus and experienced management. Risks are standard middle market credit exposures. Opportunity from banks pulling back from this lending segment. BDCs offer powerful income and private market exposure. But remember, high yields come with complexities. Understand their operations, strategies, and the risks involved. This information, accurate as of mid-July 2025, is a starting point. Always conduct your own thorough research, review their latest reports, and consult with a qualified financial advisor. They can provide personalized guidance. Thanks for watching, and here's to your smart investing.